Welcome to Book Summary Hub, where we bring you the best in book summaries and takeaways. In this video, we'll be giving you a rundown of a random walk down Wall Street and highlighting 5 practical takeaways that you can use in your own life. Plus, we've got some important links in the description that you won't want to miss. So make sure to stick around until the end, and let's get started. A Random Walk Down Wall Street is a book about investing in the stock market, written by Burton Malkiel. The central idea of the book is the random walk hypothesis, which states that stock prices follow a random and unpredictable path, and it is therefore impossible to consistently outperform the market through individual stock picking or market timing. The book discusses the various ways in which people try to predict and profit from stock market movements, including technical analysis, fundamental analysis, and market timing. However, the author argues that these strategies are largely ineffective, and that the best way for most people to achieve long-term financial success is through diversification and a long-term investment approach, rather than trying to beat the market. Chapter 1: Introduction to the book and the concept of a random walk in the stock market. The book discusses the concept of a random walk in the stock market, which asserts that stock price movements are random and cannot be predicted. The author, Burton Malkiel, is an economist and financial expert who has written extensively on investing and personal finance. Chapter 2: The History of Stock Markets and the Evolution of Modern Portfolio Theory. The book traces the history of stock markets, starting with the Dutch East India Company in the 17th century. Modern portfolio theory, which is a framework for understanding how to optimize a portfolio of investments, was developed by Harry Markowitz in the 1950s. At its core, modern portfolio theory is based on the idea that investors are risk-averse, meaning they prefer to minimize risk rather than maximize returns. To achieve this goal, MPT suggests that investors should diversify their portfolio by holding a mix of asset classes with low correlations to each other. This way, if one asset class performs poorly, it is likely that the other asset classes in the portfolio will perform differently, reducing the overall impact on the portfolio. Chapter 3: The Efficient Market Hypothesis and its Implications for Investors. The efficient market hypothesis asserts that stock prices reflect all available information, making it impossible to consistently outperform the market through analysis and prediction. There are 3 forms of the efficient market hypothesis: weak, semi-strong, and strong. The evidence for and against the efficient market hypothesis is mixed, with some studies supporting it and others finding evidence of inefficiencies in the market. If you're enjoying this video and want to see more content like this, don't forget to hit that like button and subscribe to our channel. Your subscription can make a difference in the lives of 20 children. Help us reach our goal of 2,000 subscribers. Thanks for your support. Now, let's get back to the video. Chapter 4: Behavioral Economics and How It Challenges the Efficient Market Hypothesis. Behavioral economics is a field that studies how psychological biases and emotions influence economic decision-making. Behavioral biases can lead to irrational behavior in financial markets, such as overconfidence and herd mentality, which can create inefficiencies in the market. These biases challenge the efficient market hypothesis, as they suggest that market prices may not always reflect all available information. Chapter 5: The Role of Market Timing in Active Investment Strategies. Market timing refers to the attempt to predict and capitalize on short-term movements in the stock market. Active investment strategies involve actively buying and selling stocks in an attempt to outperform the market. There is mixed evidence for the effectiveness of market timing and active investment strategies. Active investing carries higher costs and risks, such as the possibility of underperforming the market. Chapter 6: The Benefits of Passive Investing and Index Funds. Passive investing involves tracking a market index, such as the S&P 500, rather than trying to pick individual stocks or actively manage a portfolio. Passive investing has lower costs than active investing and has historically performed just as well, if not better, than active strategies. Index funds are a type of investment vehicle that track a market index and offer a way for investors to passively invest in the market. Chapter 7: The Importance of Diversification and Asset Allocation in Investing. Diversification refers to the practice of spreading investments across a variety of assets to reduce risk. Asset allocation is the process of dividing an investment portfolio among different asset categories, such as stocks, bonds, and cash. Diversification and asset allocation can help improve the risk-return profile of a portfolio. Rebalancing involves periodically adjusting the allocation of a portfolio to maintain a desired level of risk. Chapter 8: Other factors that can affect investment returns, such as taxes and inflation. Taxes can significantly impact investment returns, particularly for high earners and those who hold investments for a long time. Inflation erodes the purchasing power of money over time, which can impact the real return on investments. Investors can use strategies such as tax loss harvesting and investing in tax-advantaged accounts to reduce the impact of taxes on their portfolio. Chapter 9: Strategies for investing in real estate, commodities, and other alternative assets. Alternative investments are asset classes that are not traditional stocks, bonds, or cash. Examples of alternative investments include real estate, commodities, and private equity. Alternative investments can offer the potential for higher returns, but also come with higher risks and may be less liquid than traditional investments. Investors should carefully consider their risk tolerance and investment objectives before deciding to allocate a portion of their portfolio to alternative assets. Chapter 10: How to create a long-term financial plan and stick to it. Having a long-term financial plan is important for achieving financial goals and building wealth over time. Tips for creating a financial plan include setting specific and achievable goals, developing a budget, and creating an emergency fund. Sticking to a financial plan over the long term requires patience and discipline. Chapter 11: The dangers of market bubbles and how to avoid them. Market bubbles occur when the price of an asset becomes significantly overvalued and eventually collapses. Famous examples of market bubbles include the dot-com bubble in the late 1990s and the housing bubble in the mid-2000s. Investors can protect themselves from market bubbles by diversifying their portfolio and avoiding overconcentration in a single asset or sector. Chapter 12: Conclusion and final thoughts on the book and its relevance to modern investors. The book provides a comprehensive overview of investing and personal finance, including topics such as the efficient market hypothesis, diversification, and alternative assets. It emphasizes the importance of having a long-term financial plan and the dangers of market bubbles. The book's ideas and arguments are still relevant to modern investors and provide valuable insights for anyone looking to build wealth and achieve financial security. 5 practical takeaways. 1. Invest for the long term. One of the main arguments of the book is that it is difficult to consistently outperform the market through short-term trading or market timing. Instead, the book suggests focusing on long-term investments and building a diversified portfolio that is designed to meet specific financial goals. 2. Diversify your portfolio. Diversification is a key principle of investing that involves spreading your money across a variety of asset classes to reduce risk. This can help protect against losses due to market volatility and improve the overall risk-return profile of your portfolio. 3. Consider passive investing. The book discusses the benefits of passive investing, which involves tracking a market index rather than trying to pick individual stocks. Passive investing has lower costs than active investing and has historically performed just as well, if not better, than active strategies. 4. Keep an eye on costs. The book emphasizes the impact of costs on investment returns, including fees for investment products, trading commissions, and taxes. By keeping costs low, investors can potentially increase their returns over the long term. 5. Don't get caught up in market bubbles. Market bubbles occur when the price of an asset becomes significantly overvalued and eventually collapses. To avoid getting caught up in a market bubble, the book suggests diversifying your portfolio and avoiding overconcentration in a single asset or sector.